Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Austin Fetz Jacks. Hey, Mr. Fetz.
Robert.
How are we this morning?
What's cracking, Robert?
It's cracking good. Me and Austin just got back from the Bahamas. Shout out Michael Bowles, one of our best friends, getting married. Shout out Ashley. Ashley, we also love you too.
Yeah, fun little bachelor party weekend, Rob. Got a little tan. We're glowing today, so that's good stuff.
We are glowing. It was about time. I was getting very white.
Well, it's summer. Get ready for beach season. You know, it's important.
Your tan was a little better than mine. I'm a little red.
I had a better base, but that's okay.
Yeah. Well, let's get to it with the question of the day. Today's question comes from Clark from Atlanta. Clark, what you got for us?
I've been hearing a lot about Warren Buffett and Berkshire Hathaway. Why is this so relevant to investors?
Thank you, Clark. Warren Buffett, he has always been kind of a staple in the investment industry, hasn't he?
Yeah, so, I mean, he's arguably one of the greatest investors of all time.
Yes.
He's been CEO of Berkshire Hathaway since 1965, and he just announced over the weekend that he'd be stepping down at the end of the year at the ripe age of 94 years old.
That's insane.
So, yeah. And
Good run.
Good, strong run. And, you know, Berkshire Hathaway's, multinational conglomerate holding company that owns a lot of different companies. You know, some familiar ones are Geico Insurance, big stake in Apple, stuff like that. But Warren Buffett, man, he's just been a pioneer kind of in the investing world, and you know he's been doing it for so long. And it's, you know, I was reading something the other day that, you know, going back to when he started at Berkshire in 1965 as CEO, they've actually outperformed the S&P 500 by like 10% annually.
Every year?
Not
like
every year,
average?
on average. So, you know, I think going back to that return is something like close to 20% while the S&P is around 10.
Yeah, that's a lot different than averaging 10% per year.
No, this is
above 10%.
Yes, correct.
Of the S&P.
And there's obviously years that you know, they underperform, but really his whole philosophy was just buying quality companies that he understands and buying them at a good price. For instance, right now, you know, market's been beat up. It had been at all-time highs forever. You know, Warren Buffett is famous for saying, you know, be greedy when others are fearful, and be fearful when others are greedy. And right now, I think they're sitting on a cash balance of around $350 billion.
Oh.
So able to be kind of strategic in these times. They've been selling off and peeling off from some of the positions, but they just own quality stuff like McDonald's, Geico Insurance, you know, Apple, just to name a few.
I feel like SFM kind of has that similar strategy.
Well,
right?
it's a philosophy that, you know, you buy quality, hold it over a long period of time, it's going to do well. So that's what we try to preach to our clients. Being able to be strategic is helpful too. For instance, if you have, you know, a certain amount of cash on the sidelines, you can kind of deploy that when buying opportunities present themselves. So it's all, you know, it's all relevant to the planning process in investing, but you know, Warren Buffett is, you know, I mean, think about that. It's 2025. He was started as CEO there in 1965.
And that's outperformed the S&P by 10% on average throughout the entire time.
That was Barron's article that I was reading. Yeah. So it's, but yeah, it speaks to, you know, he's famous for just, you know, buying companies that he understands too. Coca-Cola being a huge one. You know, think about how many drinks and stuff that they make, and Americans are buying on average every single year. But you know, he's also, you know, he's admitted too. He's like, you know, he didn't fully understand Apple. Yeah. Right. Yeah. He was kind of late to the game. Like they own a good chunk of Apple now, but you know, it took him forever to kind of, you know, to get in on Apple. He's talked about how he's lost money by not being in it early. But again, it's just, you know, his whole philosophy of buying quality, holding it, being strategic, buying stuff at a good value. I mean, he's a very disciplined investor, and kind of takes the emotion out of it. So, no, he's a pioneer in the investing world. Just talking about that run is just it's crazy. I mean, it really gets hard to fathom. You know, he's 94 years old. Oh, time to retire. You know what I mean?
Yeah. And does that? It feels like it worries investors that he's retiring, but the fact is he's 94 years old. Yeah. It's time to retire.
Right. Yeah. I think, you know, their stock, Berkshire Hathaway, took a little dip after he announced it, but you know, again, they've kind of, he's put some good people around him, like any good company, where it's like, hey, no one on this earth is living forever, so you got to kind of have those pieces in place. But you know, it is kind of, it's very cool to read about and research just all the stuff that he's done, and you know, so many of his philosophies are applicable today.
Absolutely. We hope that helps, Clark. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.